Today, we're going to talk about a fundamental concept of investing. Basically, the differences between a bear market and a bull market. The terms bullish and bearish always fly around whenever conversations about stock markets comes up. And I want to make sure say you understand what they mean. And what exactly is a bear market and a bull market? Let's break it down in simple terms. So you can say bull market. A bull market is a period when prices of stocks are rising and I say they're expected to rise. Think of a bull. Bull kind of treating the I think say Bema, right? A bull or charge it forward with the horns pointing upwards. Way symbolizes the upward movement of the stock market. Meaning say the stock price is continuously going up. Now, during a bull market, typically, you say investor confidence is very high. And the economy also is generally strong. Sounds on our unemployment rates also is low. For example, after the 2008 financial crisis, the period from 2009 to the early 2020 was one of the longest bull markets in history. Now, during this period, the stock market saw significant gains. This was mainly due to the growth in the economy and the lower interest rates now available. Now, during this period, a lot of people had the opportunity to refinance, for example, their mortgages and their personal loans for lower interest rates. On the other hand, so you can say bear market, bear quantity in the I don't even know what the tree name for a bear is. But so ni mabwa tree din, let me know in the comments down below. Okay, so you can say bear market. A bear market happen when the stock prices are falling and I say they're expected to fall. Now, imagine bear or for example, mountain biswa or sunny abafom. We represent a downward trend in the stock market. In the bear market, investor confidence is low. And the economy during that time also might be slowing down. Sounds like unemployment rates also are going to be on the rise, typically. A recent example of a bear market is what we experienced in the early 2020 due to the COVID-19 pandemic happening. During that period, stock prices dropped sharply. Our global economy facing unprecedented challenges. Now, let's look at some practical examples that are relevant today. We're going to first look at an example of a bull market. We're going to focus on the tech stock category, right? In recent years, tech stocks, be to say Apple, Microsoft, and Google, are experiencing significant growth. Obviously, the stock prices have been fluctuating, but generally, they have experienced some growth. When you look at the advancements in the tech space, you will notice there's been an increased demand for digital services. And the crack say these stocks have performed exceptionally well amidst all the challenges, which reflects a bullish trend in the tech sector. Now let's look at an example of a bear market. We're going to focus on the retail stock category. Now, traditional retail stocks face challenges with the rise of e-commerce and it changes in consumer habits. Now, before e-commerce was introduced, we all used to go into the stores to purchase goods and services, right? Now, with the introduction of e-commerce, you can sit from the comfort of your home and purchase goods and services online. Companies are willing to adapt too quickly, experience a decline in the stock prices, which indicates a bearish trend in that sector. Now, since we are beginner investors, we are going to look at some tips that can help us navigate the bull and bear markets. Tip number one is to stay informed. Now, we're going to try to keep up with the market trends and news, trying to understand the economic environment now because and no ever buying am I making informed decisions. Tip number two is to diversify. And I know I'm beating a dead horse on this one because I talk about it all the time. And as always, spread your investments across different sectors and asset types to minimize your risk. Tip number three is to stay calm. Now, this is easier said than done because the markets can be volatile. So you can't be volatile. It means that and shada stable. The stock price can go up and down within a short period of time. And let's try to avoid making impulsive decisions based on short-term market movements. Tip number four, long-term focus. Now, investing with a long-term perspective can help us ride out the ups and downs of the market. Now, this basically means that unless you want to be a day trader, you should not be out here buying and selling within short periods of times. Unless the stock price after you bought it goes up astronomically, then you can sell and lock in your profit. Now, I'm going to share with you a boring strategy that I use all the time. In fact, say I buy 5 stocks for $500 and each share costs me $100. What I do is I will set a price alert in the app. which will alert me when the stock price is either approaching the $200 mark or surpasses the $200 per share mark, right? My goal here, and I said, after I had invested $500 in that stock, I don't care what happens in the market, so long as I have those alerts set up. Now, my aim here is to double what I put into the market. And once I receive that price alert, say the stock that I bought for $100 each, has now reached or surpassed the $200, yeah, kind of saying price per share mark. I will then sell 50% of my positions. So in this case, I had 5 shares. I'm going to sell 2.5 of the shares that I have. And then that basically allows me to pull the money that I originally put into the market back, which in this case is the $500. And now whatever that's left is just house money. I can either sell some of them to buy other companies, or I just leave it and hold it long term. And now with the original $500 that I put in, which is my original investment, I then use that to buy a different company and then basically rinse and repeat. By so doing, you'll be able to build your portfolio value and positions over time. As beginner investors, understanding the differences between a bull market and a bear market is extremely important. Quoting the Godfather Warren Buffett, right? When people are greedy, that's when you should be afraid. And when people are afraid, that's when you should be greedy. That basically means that in a bull run, which is when people are greedy because the trend is always going up, that is arguably not the ideal time to be buying long-term shares, right? Because your plan is to hold them for long-term, and it's in a bull run, which means that the price that you are going to buy it at might be at a higher price, right? But it is best to buy long-term shares in a bearish market because that's when you're getting huge discounts on the share price. Now, I'm not saying that people don't make money in a bull market, right? Because people can make money in a bull market, especially when their investment goals or investment strategy is short term. Because in a bull market, you can ride the trends for the short term and make money and then you get out. Because if you don't get out, or as the saying goes, whatever goes up is going to come down. And if you're riding the trend and you bought at a higher price, once the stock price goes down, you are at a loss. Right? Obviously, unless you actually sell, that's when you're locking in your loss. But personally, I'd rather buy when the stock price is down because once it goes up, I make more money. I hope that makes sense. And that's it. So if you found this video helpful, please click the like button and share it with your friends and family. And let me know in the comments if you have any questions or topics that you would like me to cover. Thanks for watching. That's it. Yebishia. Sika sabi better how you basica, yes, sika. Sika sabi better how you go get more profit. No matter where you dey, America, Europe, and Ghana. Just subscribe to the channel on YouTube, Sika Sabi.